The Bitcoin network just keeps doing its thing. One block every 10 minutes for over 16 years. Transactions clear, miners get paid, and the system just hums along completely unbothered by all the noise we're experiencing right now. Bitcoin mining is a multi-billion-dollar industry that shows transparent data into Bitcoin's network health straight from the blockchain data. And today, I want to show you exactly how to analyze Bitcoin mining data to understand what's happening beneath the surface. So we'll start with basic mechanics, and then we'll look at some mining specific indicators to assess market conditions and historical data. But before we analyze that actual data, we're going to understand what we're measuring, right? So Bitcoin mining is basically a competition where miners are using computational power to solve cryptographic puzzles. The winner gets to add the next block and earn rewards from that. The network automatically adjusts difficulty every 2016 blocks, roughly every 2 weeks, to maintain an average 10-minute block time, regardless of how many miners are participating in the network. So Bitcoin targets around 144 blocks per day. When you see sustained deviations from the target of 144, it can show you whether miners are entering or leaving the network faster than the difficulty can adjust to that. So this metric shows network stability, in my opinion, rather than focusing on any real signals about the price. But basically maintaining block production around 144 usually does mean that the Bitcoin network is experiencing healthy network functions, right? So let's talk about miners and their rewards. So miners can earn from two sources: block rewards and transaction fees. During high network activity, fees can actually become very significant in relation to the price movements, sometimes exceeding block rewards during high periods of congestion or high activity, right? And fee analysis can help you understand network demand as well as miner revenue sustainability, right? So especially when block rewards decrease over time every 4 years during the halving, this will become more of a meaningful revenue source for miners, right? So the next chart I want to talk about is the market cap to thermocap ratio, or the MCTC ratio for short. This is basically comparing the thermocap, which is the cumulative dollar value that miners have spent securing the network since Genesis, since Bitcoin was first launched by Satoshi. And it's calculated by multiplying each day's block reward by that day's Bitcoin price. And we call that the thermocap ratio, or the thermo price in this sense, because we're plotting it against the Bitcoin price. And that's basically calculated by dividing the supply at that point to get the price. And so it's basically the network security budget, so to speak. And the market cap to thermocap ratio compares the market valuation to this cumulative security investment. And that's this line here. And let me just clean up these lines right here. So basically when you get high ratios in this thermocap ratio, it can suggest the market value is outpacing the underlying security investment, or the thermocap, and low ratios indicate the opposite, right? So historically, extreme market cap to thermocap ratios have coincided with major market turning points, though the metric works better for identifying like basic market phases than precise timing, in my opinion. And so the next chart I want to talk about is the miner hash ribbons. So this indicator basically compares the 30-day and 60-day hash rate moving averages. And so whenever the 30-day average drops below the 60-day average, this can indicate hash rate is declining, right? Suggesting miner stress or capitulation, or miners turning off their miners, right? A recovery signal occurs when the 30-day average crosses back above the 60-day average. Typically indicates when weakest miners have been flushed out and conditions are pretty much stabilizing and the network is going back on track to stability, right? So this indicator has historically flashed alongside these major market bottoms that we've seen in Bitcoin's history, although it's more useful for understanding basic miner health, in my opinion, than predicting immediate price movements, because as you can see, it can be quite good at determining when the price has been experiencing like low prices basically, and when it can when it could turn around historically. But generally speaking, I don't think this is something that you should use to predict exact price movements. So the next indicator I want to talk about is the Puell multiple, and this was created by David Puell at ARK Invest. So the Puell multiple compares daily mining revenue to its 365-day moving average. The values above 1 represent above average profitability for miners, while below 1 suggests below average condition for miners, right? And historically speaking, extreme conditions in this ratio have corresponded to market tops in the past, and very high values can indicate unsustained mining profitability during these euphoric periods, and very low values, on the other hand, can suggest that mining has become very, very unprofitable for miners in the space. And this metric is useful for identifying when mining economics are in pretty much extreme territories relative to historic norms. But I don't think you should use this alone. I think it's best used as an indicator with other indicators for confluence, right? So yeah, the limitations for these mining metrics that I've discussed are typically lagging in price movements and work better for understanding medium to long-term trends rather than, these short-term trading signals, and more useful for overall market health. So these indicators help answer questions like, are miners capitulating? Is the network becoming more or less secure? Are mining economics healthy? Like the Puell multiple can really explain when miners are profitable and when they're not being profitable, right? So in 2022, we saw that this level really, really dropped from the peak in 2021. And conversely, in 2017, when this ratio was pretty high at 4, it dropped all the way to 0.31 below 1 when we saw that final capitulation event in 2018. So understanding mining economics can give you insights into Bitcoin's foundational layer, the security and infrastructure that supports everything else. But I don't think they should be used as a one. I don't think you should bet the farm on with these indicators, right? So thank you guys for watching. As always, these metrics are available on chartandspec.com if you want to track them yourselves. And thanks for watching. Bye.